let's look at gold versus the US dollar. First off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. So we have the pair here reflected through the GLD ETF. So basically it is gold vis-a-vis the US dollar. And that is very important to be aware of because gold has strengthened or weakened vis-a-vis many different kinds of currencies. It is especially interesting to look at how gold reacts to the dominant, currency, which is the US dollar. So here is GLD. We still have this humongous, gargantuan cup and handle pattern. So over many years, we formed a rounding bottom. Then this pullback is a part of a most likely cup and handle pattern. If we were to guesstimate how long the cup will be in a duration, we could compare it to this move here. So this was 560 days. So if we were to measure from, let's take it here. So 560 days, that pushes us actually into, it actually does push us here to the late part of January 2022. So yeah, that is like, a projection possible, but it means that, this handle is in, approaching its later phases. If we do some comparison here, assuming that there could be some mirror effect, we do see something interesting. So here you have this, so we have this big rally, sharp pullback, big rally, sharp pullback, big rally, sharp pullback, and just a little bit of a rally, but you do see that there is a similarity between this and this. After that, we did have this more major formation, which is reflected here. So there is a bit of a mirror effect going on. What we saw here is that after that formation, like we had here, we did have sort of like a W pattern again, and we are we could possibly be forming that going forward. Of course, this is purely like hypothetical, but so far we have seen this mirror effect of this pattern vis-a-vis this move. And there could be some deeper mathematical relationships happening here that, in which it makes sense that we could have that mirror effect continue. So yeah, it's just an interesting hypothesis. Okay, but anyway, I do think that this recent pullback, it isn't really a disaster when it comes to gold. We have made a lot of progress, and by cooling down significantly before the breakout, it makes the move more sustainable. When we go here to daily data points, it becomes interesting. If we look at the blue 100-day moving average, almost surgical resistance, then we get support, surgical resistance, support, support, support. So that is a pretty key moving average, and given that we have reclaimed it, there is reason to be somewhat speculatively bullish, beyond the potentiality of that mirror effect, which also would be bullish. The problem for the bulls, however, is that we are below the 200-day moving average and the 50-day moving average. And they are really big deal moving averages, hence we do need a significant catalyst to break above them. Another key point is that we do have a very interesting technical pattern, so let's get that thing out of the way. So we do have a major inverse head and shoulders pattern. It is unfortunate that the right shoulder is a bit lower than the left shoulder. That is not ideal when it comes to inverse head and shoulders patterns. You also see here that this high is significantly higher than this one. That is also not, it is not like a huge problem for the bulls, but it reduces the probability that the inverse head and shoulders pattern will work. But there is a potential catalyst that could alleviate these issues, and that is seasonality. So if you look here at July, so let's actually measure here from the beginning of July. So we go here. So far the move in July has been positive 2-ish%, which is slightly above what we tend to see on average for July, which is 1.3%. The good news is that August is stronger in terms of the average gain, 2.3% over the last 10 years, and it closes higher 67% of the time. When we go to the last 18 years, then we do see that August is very promising. It is the only month that is stronger than August is January, and the average gain for August is around 2%. So let's actually measure that, where would that get us? So if we measure from the current level here, so a 2% move, it would get us above these two key moving averages. So let's say that, let's also just compare it from this point, 2%. Yeah, so 2%, it does enable us to get above those very key resistance levels. The good news is that, well, in terms of getting over them, it's good news that the red 200-day moving average and the 50-day moving average are pointing downwards, which makes it, easier to get above them. In the bigger picture, it certainly is not a good thing to be faced with a declining 200-day moving average, because that is technically, a bearish setup. So it's a bit of a conflicting thing where, yes, it is a bullish signal to get above them, but the context in which we get above them is not ideal. When we go here to Finviz and look at the trend lines, we do have this trend line support, and we do have some resistance up here. But to sort of put all the evidence together, I think that the pullback we have seen in gold is not, it's not like a huge disaster as far as the long-term bullish thesis goes. The cup and handle pattern was talked a lot about, even during the formation here of this rounding bottom. We do see that mirror effect between what happened in 2011-2012 to what we see now. Yeah, though the context is most likely different in the sense that this pattern it moved to the downside clearly, starting a big bear market for gold, while this pattern, given the context, macroeconomic context, it is most likely going to resolve to the upside. So we will have then a major breakout for gold. So long term, I am certainly bullish on gold. Looking shorter term, we do have that support from the 100-day moving average, and the seasonality is promising. Yeah, and the potential mirror effect from what happened in 2011-2012 could also help us out. So, and clearly, the macroeconomic context with the central banks printing like crazy, and obviously having been put in a very vulnerable position. They are stimulating the market frantically because they have to. It's not, it is pretty clear that they are in a very vulnerable position. The huge super catalyst for gold would be clear signs that they are in a desperate situation.